Rio Tinto is always a very looked at stock. It pays a very high dividend yield. And especially during the pandemic and after, they paid a 40% dividend yield. Now it came back down to 7%. So let's see if this miner is a buy. First of all, we can see most of her money comes from iron ore. 11.4 billion in free cash flow. They have some aluminium. They have some copper. Here they're building out. Soon a mine is gonna open up, which is gonna produce a lot of copper. They used to have coal mines, but they sold those off long ago. If you would look at their revenue, you would say they have kind of stagnated since 2011, but that takes away from the growth inside the business. If you look at iron ore prices, they had peaked in 2011. They were extremely down in 2016 and now they're kinda back to normal levels. So when we consider that 2011 was such a peak in iron ore prices, but we kinda have the same revenue, it shows how much Rio Tinto has grown as a business. You cannot only look at this business as a no-grower. Revenue is highly dependent on iron ore, but in the long term you'll also have slight growth in this business. Some miners you would look at and say, oh, we have 10 billion in free cash flow per year, but they're not investing in their mines, so eventually the reserves that the mine will have will run out. Well, Rio Tinto is still investing in the mines, and they're gonna ramp up production even more. They're gonna spend 3 billion on growth capex. Currently they're only spending 1 billion, but that is still a significant amount of money. That means there's gonna be future growth in the business. So when people say Rio Tinto is just a cyclical, it will never grow, that is not true. Yes, it is cyclical, but it has growth in it because the management invests in the company. And they have mines all over the world. Of course, most are in Australia, that is where they're from, but they're opening up mines everywhere. They're ramping up in Mongolia, they're ramping up in Africa, they're investing billions of dollars all over the world. So only because it's a miner doesn't mean it's not gonna grow. One risk with this company you have though is the Chinese economy, because so much of the iron, which is produced in Australia, instantly gets shipped to China. So if the Chinese economy is doing poorly, then they can also not sell the iron at such high prices. Even if they increase production, their free cash flow might go down, especially with aluminium. They had a huge reduction here. Now, what are they doing though? They're paying out a lot in dividends. Of course, they had the one big year, 2021. Every year also, this is where iron prices spiked. So of course, they paid out a lot in dividends there, but they usually pay out around 60% in dividends, which is not too much. It means they can invest in the mines. For example, if they said they're gonna invest 3 billion per year in those mines, then they can't pay out more than 60%. And that is good because otherwise you're just taking away from the business and eventually revenue will decline, and if they sometimes have excess cash, they will pay it out. But now, where they see they have to invest again, they will not pay it out. So don't expect stable dividends from this company. They will change over time, but they will usually always pay out 60% of their free cash flow, which can be volatile. Their net debt is at 4.2 billion, so the company is not at all over leveraged. With $7.7 billion in free cash flow, that is less than a year of free cash flow. So the company is excellently positioned if they want to buy new mines, invest in new mines, and sometimes they also do share buybacks. They had an increase in shares in 2010, but since then they occasionally started a share buyback program. The amount of shares is back down to 1.6 billion. Now we can see with a free cash flow, over the long term, steady growth. Of course, we have the peaks when iron ore prices peak, like here, and very reliable free cash flow. Basically only one time off where they didn't have free cash flow. Same with the dividend, they have always greatly increased that over time. And as long as they keep investing in mines, you can probably expect a dividend increase. But overall, sometimes you just have huge investment phases over here, which are necessary for the company from time to time. So what do I expect? If I would own Rio Tinto, I would expect the business to continue investing. If they stop investing in growth to pay a higher dividend, I would get out of the stock. This business has been long going because it has been always focused on growing. Not a lot of miners do that. Usually a lot of cyclicals squeeze everything they can out of a business in dividends, and then they eventually go bust. Not Rio Tinto. They have low leverage, they continue to invest in growth, so the dividend is gonna be a bit lower, but there are of course some risk. There's always the risk when it comes to their prices. They can't influence iron ore prices, they can't influence aluminium prices, they can't influence copper prices. So you have a risk of global prices going down, just like maybe because the Chinese economy is weak, other reasons, but you do not have a business risk. The business is diversified over many countries and it is very conservatively managed. This business is not gonna go bust. The only time they had a lot of debt was in 2007 when they did a huge acquisition, but ever since then they basically had low debt amounts. Maybe they will start buying back shares again once they have excess cash. I do not expect it to happen in the next 3 years unless iron ore prices spike, just because they're investing so much in growth right now. So I wouldn't even want them to buy back shares at this moment. Now they currently make $5 in free cash flow per share. Let's say they grow it by 4% for the next 5 years, 3% after that. We take a 65% payout ratio. I know, usually they do 60, but usually when they have a bit of extra cash, they pay out a bigger dividend. So let's take it at 65%. That would give us a value of $55 a share. That is slightly below the $62 a share it currently is at. Now what if it goes a bit better? 5% and 4% and a 15 multiple. Remember, it's a cyclical, it's gonna have a slightly lower multiple than comparable businesses. Well then we would come to $65 a share. Well then, yes, we would have a buy. What if it go worse? With worse, I usually mean the business deteriorating, but I do not see this happening. Maybe iron ore prices are gonna stay low for a long time, but the business keeps investing in itself, it doesn't have debt, so there's not a risk that it's gonna go bust. So let's say it going very bad as only 2% growth for the next 10 years. And even with a 12 multiple, we will still come to $47 a share. What do I see Rio Tinto here as? Could it be a buy? Maybe. Maybe my estimates are a bit too conservative. Maybe they will start buying back shares again. Maybe iron ore prices are gonna be a bit higher. The Chinese economy is gonna recover. Or Africa's gonna need more iron. You never know what happens to iron prices. Especially with the huge investments Rio Tinto is making, maybe they're gonna grow faster. But I wanna be conservative. This is still cyclical. Now, will I buy it right now? Probably not. I won't add it to my portfolio. Great times to buy this stock is usually when iron ore prices are extremely down. For example, in 2016, when iron ore prices have been at the lowest they have been. You would have more than doubled your money and have gotten a hefty dividend since then. With a dividend alone, you would have nearly made 10%. So this is probably the times when I would buy a stock like this. It's not a bad idea to buy it in my opinion, but I would like to wait until the price is a bit lower. If there's a crisis with iron ore, I will be happy to add in my portfolio. What do you think about it? Write down below. Have a good day.